Hi, I'm Tom Stevenson and welcome to Construction Business Management, Running a Successful Construction Business. This is Module 4A and we're going to be talking about financial management. We're going to be introducing this part to the course. Maybe before we start jumping ahead though, we'll do a quick review of some of the things that we've talked about. We've discussed so far in the course how many GCs, they work in the business but don't spend enough time working. Do you know what the blank is? We quoted Michael Gerber on this from his book, The E-Myth. And that blank would be don't spend enough time working on the business. We're very good at construction in working boots on the ground on the project, and there's nothing wrong with that. But we have to get the projects, and we have to manage the projects, and we have to be able to pay the bills as well. So working on the business helps us with that, and that's what this course is all about. Business plan, particularly for a construction related business, which one of those, how far ahead does it look forward? I know we're in a fast changing world, but it still doesn't preclude the time period that we actually have to think ahead. And construction projects typically aren't short endeavors, so we have to think a little bit longer. So 3 to 5 years is generally what we plan for a business plan in construction, and generally what banks and people providing financing will be looking for. And business plan forces you to focus on, well, definitely it focuses on the product or service that you're providing. Are you working in the commercial sector? Are you working in the residential sector? Are you working high-rise? Are you working low-rise? Are you working in the renovation sector? Are you a trade partner? What is your business? So that would be your product. The market, what is the market like? How are you going to get the business that you need out of this market? So that ties to our marketing side of things. And then there's the management of the business. We have to have like an operations plan on how we're going to lead and operate this business. And lastly, over here, we would be looking for the financial side. And actually, there's a lot more here that's not even listed, like the human resource side, which we'll get to in this course as well, which will tie into the management. But the other side is the financials, and we're going to be talking about the financials today. So we're going to discuss some of the reasons businesses fail. And these usually lead to usually businesses don't fail if they're making lots of money and they have adequate cash flow to pay their debts. That's not usually how businesses fail unless they've been doing something illegal. We'll be talking about the reasons businesses fail. We'll introduce a concept called the planning fallacy and how to avoid this trap. And it's been kind of associated with the construction industry fairly wide and large, particularly big infrastructure projects. And we'll introduce you to the 3 financial statements. And the 3 financial statements are the income statement, the balance sheet, and the cash flow statement. We'll be spending a separate video on each one of these coming up in succeeding lectures. So some reasons why businesses fail. Well, number one, not being willing to recognize that a problem exists. Sometimes people get so entrenched in the process and in the business, they don't want to admit that there is a problem. And sometimes the problem, quite honestly, is pretty difficult to solve for some businesses in certain situations. And you just keep going at it until you've invested your life savings and it's all gone. Sometimes people let their ego get in the way of their decision-making process and they don't want to admit that there's a problem. And so you keep sort of going down the same wrong path and it just accumulates and causes negative consequences. We run into this a lot in businesses. You kind of get stuck into a certain way of doing things. The world changes around you. And you want to keep doing it the same way, except the world's changed around you and it's not going to work any longer. So sometimes having some external advice, somebody that can look at it without having that attachment, that mental attachment, emotional attachment to what's going on, can be helpful to help you think outside the box. Sometimes you get stuck with inward thinking and the answer can be pretty clear sometimes. falling behind, as I said, with changes in the industry. We want to be able to stay educated and keep up with the changes that are occurring in the industry, as we've talked about earlier in the course. So we want to make sure that we're well connected, rejoin appropriate professional organizations, be involved in LinkedIn, be involved in your local construction association, make sure that you know what's going on in your industry. Again, you don't want just an inside view, you want an outside view. And then, quite honestly, a lot of businesses, they become complacent. They're not as excited about the business as when they first started. Maybe they found a good business model that they were able to monetize, and they kind of just are sort of staying the same. And they may be leaving themselves in a vulnerable position where, as I said, if things change fast enough and you're pretty complacent, then you can be easily overtaken. So you really want to think about the opportunities that are around, and you really want to be able to see where those opportunities may take you. For example, insurance restoration could look to bad weather times as an opportunity to get on some insurers' preferred list because they need people at these moments in time. Sometimes if you're proactively thinking about things, opportunities, it can be really, really helpful for you to be able to grab on those opportunities. And that's, I think I mentioned in the previous video, but in case I didn't, one of my former students said he was reading the newspaper, saw that this large construction company, Carillion at the time, was going to go bankrupt, and knew that there was a very good person that was working there, so he went right after trying to recruit them. Made a lot of sense. That's being proactive. That's thinking ahead. So that's an opportunity. Somebody else's, it's maybe not such a good thing happening to that company, but it may be a good opportunity for you. Green sustainable markets will offer bigger opportunities for market penetration. During times of energy cost escalation, changes in government regulatory requirements and building code requirements can be an opportunity to seize upon. And sometimes it's positioning yourself so you can readily move into that marketplace. I can think of the net zero program that's offered by the Canadian Home Builders Association. Kind of very forward thinking. We know the building code's moving that way towards 2030. And as a builder, to be able to be certified and already building some houses will give you the skill sets to really take advantage of those changes as they're occurring. So there's a lot of potential. It depends on what specific sector you're in, but there's a lot of opportunity and there's a lot of potential. And you've got to be sort of being attuned to it. Doesn't mean that you jump on every new shiny object that you see. That's the other thing. You have to be a rational optimist. You can't sort of just be utopian optimistic about everything, because you only have so much time and so much money, and you have to sort of target certain areas, pilot certain areas, test them, and see how they work. But to do nothing all the time over a long period of time is leaving you vulnerable, to be sure. Failing to understand and apply markup. Well, that's going to be one of our topics, not in this particular video, but in the next video, is really understanding where your cost structure is at. So what are our direct costs? And, people that come from a trade or a trade background or have studied construction a lot, they're pretty good on direct costs if they've taken a number of estimating courses and that sort of thing. Sometimes where businesses fall down is really understanding what their overhead costs are, what that implies to their overall business and running it sustainably, and what kind of profit targets they should be aiming for, and then how to monitor that and ensure that they're achieving it, and also being able to get the feedback and understand, well, we targeted 8% profit, we achieved 4% profit. Why 4% instead of 8%? And what are the differences? And really sort of being able to dig into the data and understand what the data is telling you, so that you can institute improvements in your systems, improvements in your actions on site, your methodologies, a number of factors. But if you really don't have a pulse of what's going on in the business, and you're going to keep doing the same things, and you're not going to really recognize, or maybe you're going to recognize that this is where we're losing money, but it isn't actually that, it's this. So it's very important to really understand that. And that's where a lot of smaller businesses kind of fail in those areas. Usually mid-sized to large businesses, well, they've got accountants, they've got pretty well educated people in those particular positions, and they understand markup and those numbers, and that's usually not their issue. Usually their issues are it could be QC, QA, productivity, actually targeting the right markets, getting the right clients. Those could be different reasons. Lack of projections for long-term funding. Well, by not projecting cash flow, as you'll see, that's one of the 3 statements we look at. At any point, if you run out of cash, liquidity, the ability to pay people, you're out of business, because nobody's going to work with you or for you if you can't pay them. And so even though you might have profitable projects, if somehow you didn't calculate your liquidity and your access to cash, then that's left you in a very negative way. And liquidity is just basically your ability to come up with cash readily so that you can pay bills. And that's very important, right? If you've got things that are sort of in investments and you can't really cash out of them immediately, or if they're in properties, it becomes much more difficult. So you really want to develop a plan to obtain working capital, which is the money required to operate the business operations. You want to make sure that that's been well planned out, and have a good idea of how much money you need today to run your business, and ensure that you also, if you're starting a business, that you have enough money to make it through those growing pains, which takes a period of time to get a business effectively growing. In construction, it's possible to start smaller businesses on the side, particularly in the consulting areas and that sort of thing, because you have maybe a full-time job, but maybe you have opportunities where you can do some weekend work, evening work with certain clients, and sort of build up a little bit of a base before you leave that sort of reliant paycheck. And you know, not everybody just starts a business from scratch and leaves their job. Some people will start with a business on the side and try to test the waters a little bit and get a good feeling, build up a little bit of a clientele, be able to forecast a little bit more easily, you know, how they can manage over the next few months as the business starts to take root. Projecting how much money you will need. So again, that's really understanding cash flow. It's also understanding your expenses. And from a business perspective, that means understanding your overhead requirements and making sure that you have those adequate reserves and personal reserves to be able to see it through. Lack of profitable sales. Well, that's the other thing. Sometimes you're so hungry for the work, you bid the work too competitively. In other words, you bid it that you can't even make money on it, or cover your overhead or your profit. So inexperienced businesses often think that they can do things much cheaper than they can. And sometimes they don't fully comprehend. They think they are, but they're not counting for their overhead. And at some point, that truck has to be replaced. So every day that you're using that truck in the business, it's basically wearing out in the business. So your charges better be enough to be able to pay for that truck over time, so that when you need that new truck, you've had that money put aside for it. And so you're not in business just to do the work to eke out your basic food. You're in business to be able to sustain this business, to grow this business, to help other people by setting their careers on a career trajectory as well. So there's a lot of reasons why you're in business, but if it's to be sustainable, you have to look at being profitable. And otherwise, you might as well just work for somebody. There'll be a lot less stress on you from that perspective, and you won't have your own capital at risk. And the last point there's a lot of advantages to selling your products and service on value and competitive advantage over price alone. So I know the construction industry, and there's a lot of businesses that will get all their business from being the lowest price bidder. But that's a tough slog. And so if you can grow your business too, to be adding value, that you have repeat clients that want you to do the work as opposed to somebody else, that's a big positive. And so really you're going to want to develop a competitive advantage for some of the reasons we talked about in the previous videos. The other thing is the planning fallacy. This is a item that was initiated, or a tool, if you will, by Daniel Kahneman's book in Thinking Fast and Slow. Daniel Kahneman's a Nobel laureate, and this book is renowned worldwide. Which the thinking fast part is that it's kind of going to our primitive side where we had to think really fast to jump out of the way of a lion, or, well, this morning I was just going for a walk and through the ravine, and this giant coy wolf crossed my path, and it was the size of as big as any wolf I've ever seen, and it was going like at 100 miles an hour just to get across the road where the two ravines meet, and it was quite a thing to see. But this, so that was the thinking fast part. Unfortunately, if it wanted me, I don't think I would have been able to think fast enough the way it was moving through the ravine. But fortunately, it was just trying to think about itself. It was kind of nervous, I guess, crossing the road and being exposed, so it was just trying to cross. So it really wasn't a problem. But thinking fast is we make decisions really without thinking about them. And the slow part is, as humans, we have learned to make slow, deliberate, conscientious, well thought through decisions. So we have to be, when we're running a business, you know what, sometimes you do have to think relatively quickly on certain things, but where possible, you want to be a little bit more methodical, and you don't want to just, drive after a project because you really, really want the project, and you think it's something that it's really going to build the business, but meanwhile, when you get the project, you're going to wish you never had it. And the planning fallacy tends to think this project is going to go much better than it will. Planning fallacy is kind of thinking, client wants it done in a year, that looks pretty tight, but you know what, we can do it in a year, without really thinking, how are you going to do it a year? What are you going to do differently that's going to make that possible in a year? So that's thinking more clearly about it, and understanding, well, what's got to be different? And one of my clients, I remember they were doing a big box store, and their client, they'd done a number of box stores for this client, and the clients would be very well known to you. But the box store, they wanted it all of a sudden, instead of having it done in 24 months, they wanted it in 19 months. That's 5 months less. And the contractor who'd built a number of them was wondering, like, how are we going to do it in 5 months less? It's barely that we can do it in 24 months. So they didn't want to agree that they could do it in that time frame. So what they did was they dissected it, and they kind of looked at, well, what would we have to do to make this project in 19 months? And one of the things they recognized is the client wanted it built out a certain way so they could stock it quicker. And the contractor said, well, if we could get the client to not have us build it out this way, we actually think using XYZ methodology, plus them not requiring us to build it out that way, we think we could do it in the 19 months. And so they came up with a different method that they thought out well. They did a BIM model. They did a 4D schedule with it, and really came up with a different way of doing it. And so the client went with it. They got the job, and they did it in the 19 months. And now they're like that client's preferred contractor by far. And then they're in a sector where that client is really, it's not so much about saving a few bucks on getting the store built. It's about getting the store built in as short a time so they can use it to make profit their own way, because it does bring in a lot of profit. So that's an idea or an application of the planning fallacy, and not getting caught up in the inside view where you're really sort of stuck on making it work to that time without actually really thinking it through. So you really want to think you want to avoid this sort of developing plans on a best case scenario, and following this irrational perseverance, right? That could be thought of as folly involving or pursuing a project based on the assumption that things will happen perfectly as planned. This is what Donald Rumsfeld famously called the unknown unknowns. There's always going to be something that comes up that you did not expect. And so, if you're thinking things are going to work perfectly, very unlikely that they are. So the key lesson about the planning fallacy is to be very careful when pricing out projects when under undue stress to secure the project. Really sort of how badly do we want this? And it happens a lot in the construction industry, and new businesses are especially vulnerable as they want the business really badly. So when developing a financial plan, carefully take other points of view, gather other data regarding costs, use of historical data wherever possible. That's where keeping track and tracking your operations, doing good effective cost control, setting baseline budgets and baseline schedules and managing that closely and building up a really good historical database of that information gives you really good feedback for future projects. But if you're new, you really don't have all of that information available. So if it's a business you think that you're going to be, if as a business you think the project you are pricing is going to be less expensive, you then should decide why you think it will be. And like my example with the box store, see if your logic makes sense. And if it doesn't, well, then it's not going to end up happening, right? You've got to be able to logically figure those types of things out. Financial management and the financial plan. So for the business plan, a financial plan needs to be prepared. Each dollar invested should offer a return that meets the investor's requirement. If the investor is just you, then it must meet your requirements. And so we're going to talk about this later in the course as well. What you need to think about is when you're starting a business, what is my potential return on investment? We call that our ROI, return on investment. You compare this to other choices that you have with your money. So right now you could put your money in a bank like Tangerine, and it's CDIC protected, Canadian Deposit Insurance Corporation protected up to $100,000, and you'll get 0.1 of 1%. So next to nothing, right? But you're guaranteed to get it, and you're guaranteed to get your money back within that year unless the government of Canada fails or something. We usually in investments look at what we call the risk-free rate, free rate. And the risk-free rate is things like Treasury bill. And Treasury bill is backed by the Bank of Canada, a 90-day Treasury bill. So a short 90-day Treasury bill, that's considered the risk-free rate. Because unless the Bank of Canada goes bankrupt, you're going to get that interest rate. But it's very, very, very low. Government of Greece a number of years ago, when they were teetering on bankruptcy, their bond rate was extremely high. I think it was around 18 or 19%, because if you're paying for that Greek bond at that time, you didn't know it could easily go under. So they had to pay a high premium to be able to attract people to buy it. And that's the way investments work. You know, you shouldn't be doing a project that is really risky unless you've got an opportunity for a really big return. And even then you want to weigh, is this worth it? If it goes south, is this going to bankrupt us? Or is this going to put us into a very negative position? So you have to really think those things through. What is my ROI if I invest in a term deposit, as I mentioned? What are the other alternatives? You know, as a business entrepreneur, especially in construction, if I work in this sector, what kind of returns can I get? If I work in this sector, what kind of returns can I get? If I do custom homes and renovations for people, what kind of return do I get? If I buy properties and build on spec, what kind of return on investment do I get? And they're different. And the risk levels are different as well. So those are things that you need to think about. And we will talk about that in a future video where I'll run through like the opportunities of buying a house and buying a property, tearing down the house and building a house on spec that you sell for X amount of dollars, and what the potential return on investment is and how you can calculate that. And then compare that to the risk-free rate and decide, is this worth it? Is this worth the risks? All right. So we'll look at that and try to give a basic understanding of financial statements. We're not going to try to make you an accountant in this course. That's another whole 9 yards. We just want to give you a good understanding of the financial statements and how they work, how they operate, some of the formulas that you can use to give you a good indication of how your business is performing. So there are three documents that we use. We have the projected income statements, and as I said, we're usually looking out 3 to 5 years. So the projected income statement, and this is really what the company has made over a period of time. Typically yearly, if it's a publicly traded company, you have to produce quarterly income statements and balance sheets and pro formas that are looking forward to provide the public with really good information so they can decide whether they should buy your business, buy shares in your business, that sort of thing. But for a business plan, we definitely want to look out 3 to 5 years with our income statements. It's what we're projecting we're going to be able to earn in that period. The balance sheet is like snapshots at a point in time. So the income statement is earnings over a point of time. The balance sheet is like a net worth statement, like what are you worth as of this date? If we look at your assets, your liability, your owner's equity in the business, what is this business valued at today? It excludes things like what we call goodwill. Goodwill is a big deal, so that's another aspect if you're trying to value a business. Goodwill is really the brand of the business. Like what kind of goodwill does an Apple have, right? Like they have a ton because they have a very, very high profile brand, and that's really sort of another aspect of why a share price might be trading at a certain price, because there's a lot of goodwill in that business of understanding that there's going to be a lot of future cash revenues and profits that'll come in as a result of that brand. The projected cash flow is usually only a year. So the balance sheet is usually the same as an income statement taken over 3 to 5 years, and the cash flow statement is really only yearly. It's hard to go beyond that to really understand what the projections are. So typically that's just to make sure that you've got the financing in place to cover you over the next year or so. So an income statement looks something like this. You got sales, and you've got all of your overhead expenses. So cost of sales, this is your direct costs of sales that you would have incurred in a particular year. And then that gives you your gross income. So you take your cost of sales and you subtract it from your total sales. So this would be the total sales. What you're left with is your gross income, also referred to as gross margin, gross income, gross margin, which is 185,000, or in this case, 600,000 minus 324, leave 276,000. So that's the gross income. So gross income is your overhead and profit. That's what's left for your overhead and profit. And so in this case, you've got total expenses of 145,000 and total income before income taxes, 40,000. So essentially 185,000 minus 145,000 leaves 40,000. And then maybe you have to pay 10,000 in income tax. And so that would leave you with a net income or net income after taxes of 30,000 or 43,000 if we're looking at that. So it's good to understand how the numbers work. It's simple adding and subtracting and categorizing in an income statement. You've got this cost. These are your direct costs of labor. This should be your cost of being on site managing the project. That should be in those costs as well. Overhead costs are going to include things like rent, insurance. It includes things like the estimators that are estimating projects that you never get. Who pays them, right? If that's you and it's a small business, well, that's your time. So if you're not getting that money out of somewhere, then that's a sinkhole for you. You won't be profitable, because if you're only pricing things like out at this, you're going to get a lot of work, but you're not going to make any money, and soon you're going to be bankrupt because you got to pay all these other fees. So you got to make sure that you're covering off your overhead expenses, and they're not always so easy to fully understand. So there's a little bit of thought that has to go into that, and we'll talk about that in the next video. But definitely the income statement and understanding it, and it also helps you to target things and to have some goals going forward. Doesn't mean that they're necessarily going to happen, but we definitely want to try to have a plan in place. And I think I've said it already, plans are nothing, but planning is everything. Well, that's the important part of developing a business plan. It's not that everything's going to go exactly as planned, but it does give us a sense of where we want to take things. If we find something that makes better sense to us at some point, we can change the plan. The balance sheet is, as I said, it's kind of like your net worth. It includes assets, which includes current assets, long-term assets, which adds up to total assets. There's what they call GAAP, generally accepted accounting principles. There's a whole bunch of ways that accountants are able to document this information. But for this course and the purposes of this course, it's good to understand balance sheet is kind of giving, it's like a net worth statement. What's the value of this business? Book value of this business without goodwill attached to it as of this point in time. It's a measurement. So we can see our assets, and then we can see our liabilities. That's the money that we owe. Current liabilities are due within 1 year. Long-term liabilities are 1 year and longer. You know, mortgage, things that you got to pay back over time, things of that nature. Maybe big equipment that's going to be utilized over the next 6-7 years. So that's our liabilities. And then shareholders' equity, well, that's the value in the firm. You know, when you started the business, maybe you put $50,000 into this business to start it. Maybe over the last year it made $30,000 profit. And so the profit it made last year is retained earnings if you kept it in the business, if you didn't take it out, you know, for personal reasons or as a dividend to pay yourself. So you have the retained earnings, and then maybe this year on your balance sheet, maybe you earned some extra money, and that's extra income for you. And so you add these all up, that's adding up to your shareholders' equity. And so if we take this item here and that item, it adds up to total liabilities and equity. And so this must add up to this. That's just the way it is from accounting perspective. It's not like if one's bigger and one's smaller, oh, I did this great job because look, I got more equity than assets. No, this is the principle. Total assets equals shareholders' equity plus total liabilities always. If they don't add up something, there's a mistake and a miscalculation somewhere or a mistake in one of the inputs. So that's how that works. And these things can always be adjusted here through shareholders' equity, etc. But this cash amount is really what you have as of this date available in cash. So, you know, in the bank, if you have $151,300 as of this date, then that's what that reflects. It's a point in time. All of it is taken as a point in time. So if any of you have ever worked in retail, when once a year the retail store says, oh, we have to take inventory, what they're trying to do is place a value on what they have in the store, their inventory, so that they can do their financial statements. And the cash flow statement is where you are looking at, well, what was the opening cash balance, right? So what's the opening cash balance? Don't worry about these different years that I've got on some of these. It's just giving you examples. But revenue. So we have, this is basically the money that's coming in, and this is the money that's going out. Generally, the line items for money coming in is a lot shorter than the line items for the money going out, right? That could be a lot longer listing. But the amounts tend to be higher amounts on the revenue coming in on those line items. And so this is looking at total cash received during the month. And this is total money that's been paid out. And this is the opening cash balance. And then the difference between this and this is in this case, we have a surplus. And so that's why the closing cash balance is higher. And the closing cash balance for January becomes the opening cash balance for February. So it's almost like you could think this is January 31st, midnight, or just 11:59 seconds what we have. And so the first second we have the same amount in February. So that just moves there. And then again, the whole process looks at what's the money coming in, what's coming out. And you know, if you do this as a pro forma for the year, you may with some big projects recognize, oh, maybe by July, August, we're going to have a $100,000 shortfall. Maybe we will have used up a lot of that money on some of our projects. Now, that could be good, that could be bad. It could be that you just have a lot of projects on the go. They're government agencies, there's bureaucracies, they're slow to pay. There's a lot of things that come up with that, and we'll talk about trying to be efficient in that area. But if we see that's going to occur 6 or 8 months down the road, well, that's why we're doing this, so that we can put together a business plan, go to the bank, make sure that we have enough financing in place, that if we're going to be $75,000 short in September, we have maybe a $150,000 line of credit, so it's not going to be an issue for us, because we know come maybe November, when we close out and we get our lien releases done, that we'll be in a surplus again, right? And so you want to be doing this well in advance. You don't want to be showing up at the bank in September. I need money by Friday, or I won't be able to pay my employees. That would not be good, and you probably would not get the money. So that's our introduction to the income statement, the balance sheet, and the cash flow statement. So it should give you a good perspective on how their purpose, but we'll be diving into them in more depth in the upcoming videos. So this is Tom Stevenson wishing you a wonderful day, and I'll see you next time. Bye for now.